how to negotiate a better deal with your bank. It's probably a conversation that not too many people are keen to have, but in terms of, I guess, time invested and the potential return or savings, it can be a phenomenal thing.
Yeah, 100%. I think, well, look, many of us are uncomfortable speaking to our banks, even though, the bank can't change any of the terms and conditions of your existing contract, and they find out, they're asking questions to find out a little bit more about you. Yeah, we all get a bit concerned and a bit nervous when we're speaking to our banks. So yeah, one of the things that we do regularly for our clients is actually speak to the banks on behalf of them. So we make a representation of our client's financial position, and that we're actually seeking a better deal for our clients. And if you don't give us a better deal, obviously the risk to that existing bank is that we will try and we'll potentially be moving your client to a different lender. So but to have these conversations, you've got to be prepared, and you've got to get your I suppose your ducks aligned, and have confidence in your conversation, and also understand what the bank questions will be. So they'll be keen to find out about where you're at financially. They'll be keen to know what your income situation is like, what your loan to value ratio currently looks like, and sort of almost do a mini review of the credit elements of your application, even though the loan is actually with them. So one of the things that we actually do at Lydian is go through a bit of a health check. So we want to make sure that we revisit all of those key components of credit. So the first one would be what is the value of your property and how much debt is associated with it. So that's your loan to value ratio. So if you've got $500,000 of loan against $1 million property, that's a 50% loan to value ratio. Now the awareness around that is that the lenders are more inclined to decrease your interest rate if it's a low loan to value ratio. And a low loan to value ratio from an industry perspective is sort of 70% or 60% loan to value ratio or lower. So if you were applying for finance today for new finance, and you had a 60% or lower loan to value ratio, you'd be expecting the better interest rates. And in fact, a few of the lenders actually review that on an annual basis and will reduce your interest rate. So some of these new neobanks like Athena, homeloans.com, some of the digital banks, they're starting to do this review process and actually decrease your interest rate in line with that LVR component. If your loan to value ratio is a little bit higher, but up to 80%, then you're sort of outside of that lender's mortgage insurance component. Well, then still you've got the ability to fight hard for your rate. So firstly, knowing what your loan to value ratio and knowing the sort of technicalities around that conversation is important. The next one, when you're fighting for a better rate, look, you have confidence in what type of application potentially you have to approach other lenders. So if you've got strong employment, you've got your debt to income ratio. What that means is how much income gross versus how much debt you have. If you've got a strong debt to income ratio, well, I'm talking about 4 times of debt compared to your income or less, you've got a strong application if you wanted to proceed with a different lender. So again, you've got the ability and you've got confidence knowing that you've got a low loan to value ratio, you've got strong income to support the debt, so financially you're very, very strong. The behavior of your credit has been exemplary, so you've repaid monthly, you've increased money in redraw or offset, whatever it be, and saved and paid extra on your home loan. So you've got a really good credit profile with that existing lender, and that then gives you the right to say, well, look, I know you're giving other people who are just joining the bank a way better deal than me. I've just told you how good I am. I'm a super saver. I've got a low loan to value ratio. I've got strong income. Give me the best deal. And that's exactly, well, we don't say it like that to the banks, but we articulate it exactly in that same sort of form as well. So you've got good credit history, good credit behavior. You've got strong income against the debt, and that low loan to value ratio, you should be asking for better rates. And the last thing to do is, where do you source those interest rates? So you can go online and look at the Rate Cities and the CanStars of the world and find out what those real cheap rates are as well. The other component of that, you need to understand what kind of product that you have got compared to some of the products which are advertised in the market. So some of these super cheap interest rates are just basic facilities, so they don't have access to redraw, no offset features, no splitting of the loan, no fixed component for the loan. So all of those features might be very, very important for you personally, and therefore fighting for an interest rate for a product which is not your product might not be appropriate as well. So you just got to make sure that you understand exactly what you're fighting for. So I mean, in summary, you know, the best kind of tip I can give you is really do your homework first, get prepared, get confident in those kind of credit bullet points, and then make sure that when you're making the call, you're presenting those strong financial elements to get a better deal, and be confident with the outcome. You know, so if they're giving you an interest rate and you still feel it's no good, you know, you'd like to speak to their manager or beyond. So yeah, there's a few things there, but you know, we do this on an annual basis for loan reviews for our clients. And I would suggest even clients we've been relationship managing for many years, we would on average save sort of an extra $500-600 a year minimum. And in fact, new clients coming to us when we're doing this repricing or fighting for better interest rates, when we've actually not supported them in the past, and they're new clients to Lydian, we're finding that we're saving sort of 0.25%, 0.5% or more in some instances. So saving, you know, $3,000, $4,000, $5,000 a year in interest rates reductions for that client just by asking for a better rate, which is cool. So there's no cost. Time on the phone is probably 10 minutes. You've got to be a bit grumpy about it, you know. So I'm an unhappy bank basher, and that's me. And hopefully you get the favorable outcome.